Hi, I'm Michael Davidson, TorontoCommercialRealEstate.net. In the next 3 minutes, I'm going to give you a clear, numbers-driven snapshot of what's really happening across the GTA commercial market so you can act with confidence in 2026. If you invest, lease, or own commercial property in North York, Vaughan, Peel, or Durham, this is for you. If you find this useful, please hit like and subscribe so you don't miss my weekly updates. We're going into 2026 with cautious optimism. Leasing activity is improving in the right pockets. Investors are still very selective, and the gap between great assets and everything else is wider than ever. So let's break it down by the three big food groups: industrial, office, and retail. Industrial remains the heartbeat of the region. Across the GTA, prime nodes are still seeing single-digit availability, and in some of the best located submarkets, vacancy is tightening again as new supply slows down. That's really encouraging for owners because it signals strong, persistent demand even after a few choppier quarters. Small bay and flex units in the 5,000 to 30,000 square feet range continue to attract owner users and investors who want control, operational efficiency, and proximity to major transportation routes. If you own or are targeting well-located industrial in North York, Vaughan, Peel, or Durham, the story is about solid fundamentals and careful underwriting rather than distress. The office market, a tale of two markets. Next, office is very much a tale of downtown Class A and trophy towers seeing real leasing momentum. Again, the Class A helped by stronger return to office policies from major employers. Net absorption has turned positive for the first time in years, and high quality space with great amenities is leading that recovery. But many suburban B and C buildings are still struggling with elevated vacancy, shorter lease terms, and tenants that are hesitant to commit. For savvy investors, that contrast is creating both risk and opportunity. Strong buildings and strong locations are stabilizing, while weaker assets will need real capital and repositioning strategies to stay competitive. Retail, holding firm where it matters. Finally, retail, neighborhood plazas anchored by grocery, food, and essential services continue to deliver steady traffic, dependable rent collections, and a healthy renewal activity. These community-based, service-oriented centers are quietly outperforming expectations and acting as a defensive anchor in many portfolios. In contrast, weaker, non-anchored retail in oversupplied locations is still under pressure, which means and makes asset quality and tenant mix absolutely critical. If you liked my talk today, and you would like to get a snapshot for your region, whether it's North York, Vaughan, Peel, or Durham in the GTA, I can share that with you and your partners. Just drop me a line, send a comment, and I'd be happy to send that to you as a quick reference. Thanks for watching.